All right, welcome to the Sherman Show. I am Jeff Sherman here with my co-host Sam Lau.
Hey, hey.
And today we are recording on Monday, May 22nd, 2023. Sam is proud of me because I remember to say it up front for the first time in many episodes. So thanks, Sam. I'm trying to make you proud. Today we have a special guest. We have Vincent Deluard. Vincent is a global macro strategist at StoneX, and he authors many weekly research reports talking about the global macro trends. He advises pension funds on asset allocation. And so what we really want to do is just delve into it and see where we are sitting here as we're getting ready to wind up the fifth month of 2023. So Vincent, welcome to the show.
Pleasure to be here.
Well, Vincent, most of our listeners out there who are familiar with a lot of your work know you as one of the guys who really got that inflation call right a couple of years back. And so just on that front, maybe you could tell our listeners who you are, what's your background, how you got into becoming a strategist, and more importantly, too, what people should know about your responsibilities at StoneX.
Wonderful. So, yeah, I'm the global macro strategist for StoneX, which is a Fortune 100. I work for the broker-dealer division. We do a lot of currencies, commodities, securities. I have a really fun job. I chose the name Global Macro because it means nothing. It means I get to talk about whatever I want because anything is global or macro. I write weekly reports that go mostly to institutional investors around the world. I work a lot with Latin America, Brazil, Chile. The pension funds there are big. Do roadshows, media, and I try to think of ideas that either the market is not perceiving or that are not being connected. I feel like inflation was one of these where you could kind of see all the signs. You just need to in early 20, and you could see that we were going to have this inflation, and the market was resisting this idea. So this is where I think you get your biggest alpha is when you have a high conviction call. A lot of supporting evidence. I like quantitative, I like historical analysis. And then, of course, it's hard with markets, right? Because sometimes things will go against you, but you need to have conviction in your thesis, back it out. And that's it. So how I got there, I grew up in France. I was meant to be a, diplomat or high level civil servant, which is what you do when you have good grades in France. I thought that was really not my thing. I always had an interest. Initially in currencies. I collected banknotes as a kid. I loved the images, what they told. I've always been fascinated with FX and currencies. But that's not something that is really rewarding in France. So I got lucky enough, got a scholarship to study in the US, and then I worked in research now for about 15, 20 years. I teach at a local college here in California. And I feel blessed. I mean, we are in a very interesting industry. We get to address a lot of problems, learn about a lot of new topics every day, and there's always something going on.
So let me, before we even jump into it, so you said you like to collect banknotes too. I have someone that is one, and I always say she collects money. But the thing is, how many different ones do you have? What does your collection look like?
I'd have to go back to my childhood room in Dijon, Burgundy, France. But I would travel a lot with my parents, and everywhere I go, I would try to get every banknote, every coin, and then I would glue them. And that's one of the reasons, by the way, why I hated the introduction of the euro. It's like we used to have in Europe all the foreign, the peseta, the lira, the drachma, and each of these little coins told you something about the culture and the history. And then in 1999, we launched a euro. We couldn't even agree on a symbol. That to me that is an illustration of the failure of the European Union as a concept, is that you can't even get people to agree on what you're going to put on the note. So we went with like stupid bridges, because everybody loves bridges, right? So, yeah.
Well, it's interesting too when you're talking about the history behind that. I used to do that as well when you travel. Just take a look, and you get the currency, the hard currency, and you just look at the physical note or coin, and just start trying to figure out who the individual was on there, what the building or whatever the background might be. And back then you'd have to pull up maybe an encyclopedia or, you know, some other research. You'd have to go to the library and take a look. But one thing that just struck me as well, just that aspect too, is passports. You don't get that physical stamp in most of the countries that you travel through nowadays as well. I used to like to collect the stamps on, or, you know, hold my old passports and just take a look and revisit the stamps that you would see, but now it's all digital. So for the most part, so that's another thing that's going
Well,
on.
that just shows you travel to fancy places, Sam. You know, most countries actually aren't digital. It's only when you're in certain ones. And so I actually got stamped out of San Pancras a week ago. So on the train, they still give you the physical stamp on the way out. You know, it's that foo-foo Heathrow you're using, you know, instead of
you know, speaking of passport in Europe, that was in England, that was a theme in the Brexit vote. You know, it was decided by a very small margin, right? And a lot of, at least some of the people resented the fact that they had the European Union harmonize all the passports, and
right.
the British, I can't remember the color, I think it was blue, right? They had this blue passport and they had to change to dark reddish, and there was a level of resentment. It probably was enough to make the difference. You know, there's probably enough people who voted solely based on that, and this kind of momentous change in the United Kingdom's history. So these symbols, they matter. I mean, this is what, you know, the essence of a nation. Why do we accept, you know, colorful pieces of paper as, you know, oh, here, give me some goods, give me your time, here's a colorful piece of paper? Or why do we, you know, put some of identity in that little record that the passport is? It's I think there's something deeper than you know, just
you know, well, you mentioned that too, and like the reason I brought up this whole banknote thing is I was flipping through it the other day because my wife was looking at it and just, you know, trying to put some stuff in there, and we're just noticing how just, you know, unimaginative the U.S. is, right? You know, even if we've evolved them and now they have, you know, a couple of different colors on there, but you see all these like high tech, like these clear, like plastic, like, and just the symbols. And I mean, and watching the evolution of different notes over time, I find it to be amazing. So anyway, it's interesting that was your first foray into FX there. But you know, you talk about, you know, having calls that are maybe non-consensus or things that you have high conviction in that others aren't seeing. You know, kind of what aren't others seeing today right now? We all know about, you know, the call pretty much everywhere is recession, right?
That's it.
But what are you seeing that potentially others aren't picking up and you think is really top of mind for today?
That would be the recession thing. I mean, everybody's obsessed with this. I mean, the recession should have been already there yesterday and the day before yesterday, right? I mean, if you look at the yield curve, or if you look at, you know, in traditional economist expectations, we've been talking about, oh, like the Fed is going to hike and break things, and, you know, people thought it's going to happen at 2%, 3%. Well, you know, here we are. We're at 5%, and my kind of strongest out of consensus conviction call is that we're not going to get a recession. That this banking crisis it's a rich man's crisis at the end of the day. Like, you know, who banked at Silicon Valley Bank? Who has a private banker at Credit Suisse who, you know, manages their high net worth for them? Even this debt ceiling stuff. I mean, all the issues that seem to consume the financial media. If you really dig beyond it, it's like, well, you know, yeah, it doesn't impact that many people. My view is the economy has been stronger than people have thought for a very long time. Consumption is still extraordinarily resilient. We haven't run through these excess savings from COVID yet. And we have the tailwind of extraordinarily high fiscal spending, both at the federal level. I mean, we ran a $700 billion deficit in the first 3 months of the year. Like, whoa, you know, you need at least a year to do that. Like, now we can do that in 3 months. If you just and then the state level, maybe I'll get into that later. I think that's the big one that people are missing, is how much money states
wasn't everybody up in arms when Obama had that, you know, $1 trillion year, right? It was a $1 trillion deficit, and it was like, oh, we're ruining the country. And now, you know, like you said, we're running through that every 4 months.
Yeah, and I'm a Canadian guy, you know, like I think we kind of forgot, you know, because of the ideological shift in the 80s, And then the focus on monetary policy for 40 years. Basically, we've kind of outsourced economic management to central bank, right? It was the maestro Greenspan, right? I mean, fix it for us, please. And monetary policy is kind of lame. We've done it for 10 years, trying to boost the economy by buying bonds, and doing QE and getting rates to zero. We got nowhere. On the other hand, when the government does spend money, that is real money that gets spent in the economy and gets you fiscal multiplier, especially if you give that money to poor people, which is what COVID did kind of on accident. But that reversed a 40-year trend where we took money from the poor to give it to the rich. COVID kind of, did that proper Robin Hood thing. And yeah, it works. It works. I mean, it comes with side effects that are not pleasant, like inflation. But if your goal is to boost nominal growth, spend a bunch of money, give money to people, and you'll see it come back.
Yeah, you mentioned that the banking crisis was a rich person's problem. And I kind of think about that about QE as well. QE really did help the asset owners, right? The people who are risk takers, the ability to borrow money very cheaply, which, as you said, the lower income and economic strata doesn't get to participate in that. And so maybe dig deeper onto this and explain why you feel that having this, kind of fiscal money multiplier, having some level of inflation is accretive to the overall economy.
Yeah, just to bounce back on your QE idea, right? The term, the economic transmission mechanism, is called the wealth effect.
Yep.
I mean, it's in the word, the wealth effect. Who benefits from the wealth effect? The wealthy. I mean, that's like the fact that this did not get called out when Bernanke had his famous speech in, I think, 2010, basically said, well, if the stock market goes up, then everything is going to be good because the rich people, I mean, it's like trickle-down economics, but even worse, because in trickle-down economics, at least there was some level of entrepreneur, like, okay, we're going to boost business creation and we're gonna free job goals, basically. Like there was an idea, there was a mechanism through which giving money to rich people would create economic growth. With a wealth effect, it's just like, no, we're just gonna give a bunch of money to people who already own assets, and hopefully they'll spend that money and eventually the economy will grow out of it. So yeah, I think this was bogus economic theory, and that cost us 10 years of subpar growth. And now we have we kind of, I would argue, sleepwalked into Keynesianism, right? I don't think that was the plan. I mean, it was for Trump. I think when Trump was elected, he kind of had this, all right, I'm gonna run it hot. But then, as interest rates picked up, then we ran into these liquidity issues. We had the repo market freeze. So what you need is both the fiscal stimulus to boost growth and also a tremendous injection of liquidity so that the private sector could deleverage. Because one of the problems is, when you try to boost growth with Keynesian stimulus, Japan has done that, tried that 20 times in the past 40 years. When your private sector agents are highly leveraged, that doesn't work, right? Because eventually interest rates start to rise and you see banks start to pop up and you have issues. So you need both a one-time shot in the arm of massive liquidity, and then you get the stimulus on, and then you can reset at a higher path for growth, rates, and inflation, which is where I believe we are.
So with that, one of the things that you talked about earlier is you mentioned just the fixation by the media on certain topics, and the topic du jour also, beyond inflation. Inflation was kind of, as you mentioned earlier, a bit of last year's topic. What seems to be here and now right now is just the fixation on this X date and the debt ceiling, and part of it, entails what we've been talking about, some of the fiscal stimulus in there. I guess my question isn't really about this estimated date of the X date, but this is almost a merry-go-round, right? We've, especially since 2010, it seems like it's occurring with more frequency, where we do hit up this debt limit based on the ceiling. I guess my question is there a way out of this fiscal, if you want to call it imprudence, in terms of not being able to run a balanced budget? And also, just the debt ceiling itself, since it's hitting up all the time, a lot of people throw out the notion of eliminating it completely. I guess, where do you stand on this idea of elimination of the debt ceiling? Can we eliminate it entirely, or do we just start to think about whittling it down, perhaps by thinking about balancing a budget and having an annual surplus instead of a deficit?
I would be against the idea of balancing the budget. I don't think the budget needs to be balanced. I mean, let's go back to, me collecting coins in 10-year-old me, getting Deutschmarks and clipping them in my book. Someone needs to issue these little coins. At some point, there needs to be an injection of money in the system that is not offset by production. I mean, public sector accounting is fundamentally different than private sector accounting. Yes, I need to balance my books because I don't have a money printer at home. Corporations need to, states, local governments, they do. The rules do not apply to governments. I mean, this is kind of the idea that we were talking about earlier. Like, why do we accept, these little pieces of paper as that's seigniorage? This is the oldest definition of sovereignty. Is you have to accept my debt to settle your private transactions. Whoever gets to make that claim created a resource that he can use to build palaces for himself, that he can use to invade his neighbors, or maybe that he can use to form his government and build a good healthcare system. But that resource exists, and I think it's a major flaw in traditional economic theory where we ignore it, right? We have this the money veil, the money is neutral, right? It's just like a unit of account, but what we're changing is just goods and services, and money is just a convention that we use to settle that transaction. No, there is this ghost in the system, which is the free issuance of money by the government that you can use. Now, of course, it's not infinite. The only limit, and different countries have different limits. I would argue the limit for the US is very high because we have the world reserve currency. So there's a lot of demand for a currency, right? If you issue the Argentine peso, I mean, you already have trouble convincing your citizen to just hold your peso but the dollar, no. You can issue the limit to that issuance, the limit to the amount of deficits we can have is inflation. And we've hit that limit. Like, I'm not arguing that we should just, spend the way like Venezuela or Argentina does. But the notion that, we need to balance the book is wrong. At the end of the day, it's a trade-off. Like, how do we want to finance the government? And do we consider that a certain level of inflation is an acceptable way of financing the government? And I would argue that it is. Of course, I'm not arguing for like 7-8+ % inflation, like that becomes problematic, but 3-4% inflation, if you have a highly indebted society, if you have a lot of difficulty raising taxes, it's a choice. Inflation is at the end of the day, everything is about transfers. And inflation is a transfer from, I would argue, the asset owner to the workers. And I believe that after 40 years of transferring wealth from the workers, the poor, and the young, to the rich, the old, and the retired, we could have a little bit of it flowing backwards.
Yeah, it's funny you mentioned that, because one of the big concepts in economics is the fight between capital and labor, right? I mean, that's really what we talk about, like, in various cycles. And you've seen labor have an upper hand post-pandemic. Right. Some of it is because of the metrics you've mentioned, but also we've had somewhat of a shortage of labor in this country, right? We lost people just to unfortunate death, but also we lost some immigration as well. Yes. And so, you mentioned this idea of, 3 and 4% inflation being somewhat acceptable. It's so funny to me. I've always joked that why is price stability 2% inflation? To me, price stability 0. But, obviously they want deflation, because then you get, in this supposed spiral. So we've agreed on 2. So why is 3 okay? Why is 4 okay? And where are the academics wrong on this concept of 2?
Okay, first of all, the concept of 2, is not, if you want to go by the book, and there I'd be right there with the libertarian hard money type guy, price stability means 0. It's a joke, right? That the 2%, so how the Fed now defines price stability is a stable rate of inflation, which I think Friedman once observed, well, if we had 10,000% inflation every month, but steady, job well done, guys.
Yeah.
So it's a joke.
I don't really. I could say, like, to help our debt.
Yes.
But, not to buy anything.
Yes. So that would be my point. But the 2% thing, they made it up. How did they make it up? By the way, an 80s press conference in New Zealand. They had a problem. I think it had to do with the common market or whatever. Like, inflation problem in New Zealand. They get some RBNZ got economists on TV, and then the journalists, well, what's a good level of inflation? The guy's like, 2%. Why? Not too high, not too low. That's it. That is all the science that there is behind the 2% target. I would argue that, people talk about ad nauseum about the R star, the neutral rate of interest rates. It is neither accommodative or whatever. Like, I mean, it's kind of a BS concept that people use to write academic papers and get jobs at the Fed.
But that's why Williams is still in charge of the New York Fed, right? He's the R-star guy, right?
Yeah. Well, I would argue there is another important concept, which is I star, the optimal level of inflation that a society needs at any given point. I would argue this I star kind of changes over time, depending on demography, depending on growth, depending on debt levels. And, for the past 4 years, I would say, yeah, I star was pretty low because we had all these boomers coming in the labor market, aging, having lots of savings. We had a lot of foreign savings, a lot of savings out of Europe, out of Japan, out of China, out of commodity producers, where the huge shock of China's entering the WTO. So yeah, prices, naturally were either falling or at least not accelerating. So it was totally okay to have a low inflation rate. I think now we are in a different world. And you mentioned these labor shortages. And, they're mostly demographic, right? I mean, we have basically 2 boomers that are retiring for every Gen Z that's entering the market. Of course, it's going to put pressure on wages by definition. I mean, unless we accept like a tremendous amount of immigration, which we're not willing to do, it's math. I mean, so yeah, we can keep hammering it, we can keep fighting it. I guess if we throw the economy into a deep depression, we'll get to 2%. But why? Instead, we just accept, well, that is the way it is. You have 2 guys who are retiring for one is coming in. The guy who's coming in is going to ask for more money, because he has to work more, because collectively the young generation has to bear the burden of basically paying into the pensions for the boomers who are retiring. So we need wages to go up and with asset prices to go down. That is healthy. So your I star is probably around 3-4%. The other way you can justify that I star is with a fiscal lens. So if you're into, public, it's not public sector, but basic math, really, over time, you want your debt to GDP ratio to be more or less stable, public debt to GDP. Otherwise, you end up in the path of Greece, Argentina, debt keeps going up, and then you have to service that debt. Eventually, you will go broke. So you want to stabilize that debt to GDP ratio. Now, what does that mean is that the new debt, which is a deficit, needs to grow at the same time as the denominator. So numerator is a deficit, denominator, if you look at the change, denominator is a kind of nominal growth. So if you are in a world where your deficit on average is 3-4%, which is where we're in the 2010s, you can get there with 1.5% growth, 2% inflation. Your nominal growth is 3.5-4. Your deficit is 3.5-4. You remain stable debt to GDP. My impression is that we've moved to a new world. We're talking about that 700 billion deficit in 3 months. Like right now, we have full employment, and the deficit is around 6.5% of GDP. So we need to have your nominal GDP grow by 6.5. Now, are we going to have real growth of 6.5% in the US? I don't think so. It's going to be like around 2% trend growth. That's 2% a good year. Huh? So you need to make up that gap with inflation. And again, 4% inflation, 2% with growth gets you to that 6%. You can run a big deficit. You can pay the boomers the pension. You can keep paying for whatever foreign war you want to get into it. It's a new normal.
Yeah, well, this all reminds me of where we were kind of prior to the whole like QE infinity type of world, was that there was this concept of nominal GDP targeting, right? In GDP targeting is what it was called. And when I listen to you talk, I'm just reminded of it, right? That, we can't always, we can't really change this real growth mechanism, but we can affect somewhat is the nominal GDP side. And, we kind of have said it tongue in cheek at DoubleLine that, we thought maybe when the Fed introduced this whole concept of average inflation targeting, the goal was to be a nominal GDP targeter and let the upper end of the bound move up a little bit, get to 3 or 4%. Do you think that the Fed has really kind of, they have the egg in their face because of it? They wanted the 3 to 4. We got the 9 handle at one point. It looks like we're going back into at least a low 4 this year. Do you think they still have the ability to kind of think about that? Or do you think they've been so shell-shocked by what they saw and experienced roughly 18 months ago that they're just going to struggle to really change that mindset?
That's a great question. Yeah, I think there's an aspect of they messed up. Like that's not helpful. Like they messed up in 20, like I'm not talking about COVID, like we didn't know what it was. And yeah, in hindsight, we overreacted on a bunch of stuff, but at the time it was scary. But like in November 2021, these guys were still buying mortgage-backed securities. What are you thinking? We had like, house prices up.
March of 2022.
So, yeah, sorry. Yeah, I got the, yes, that's how insane this was. December, right? I mean, like you had like real estate prices up by like 50%. Miami condos were up by 200%. I mean, you had people like, what are you thinking? Like that was insane. Like I'm not questioning like monetizing the deficit early on and then pouring, like when you had the fire, yeah, you grab the biggest hose you can and that's what they did. But like why they kept the hose flowing, that's contributing for sure. Like the explosion in M2, like you see on the chart, like yes, my base case is that inflation would have been is kind of trend rising, right? It was 2% before COVID. It was going to slowly raise to like 3, 4, 5, which is kind of where I see my I star. It would have done that naturally. Now the Fed had, Fed plus COVID plus lockdown plus Russia, all of that got us to 9%. So yeah, now that kind of creates a credibility problem for the Fed, right? Because if they had done the right thing, it would have been progressive, would have naturally gently resettled in that new world. Instead, now they need to look tough, right? So I think that's kind of where we are now, where if I could read the heart and the soul of Powell, I think he's pretty happy with the way things are. You know what? He got the Fed funds rate to 5%. Inflation is falling to 5%. He got the positive real rate. I mean, he wants to say job done, mission accomplished, and kind of like George W. after invading Iraq, like can't find WMD there. The war's going horrible. You just get into a big warship and mission accomplished. I think that's what he wants to do. Now he can't do that, right? Because the memory of the mess up is that I don't think he has the drive, and nor should he really, to try to go back to 2%. So I mean, he needs to keep talking out, which is why you saw like the Ballard last week, and a couple of Fed guys go on TV say, okay, we can do 1, maybe 2, maybe 3 rate more hikes, and just to kind of talk tough. But I think he's done.
Yeah, I do too. Let me just ask one more thing, because I know Sam works on our asset allocation stuff, so he wants free asset allocation advice as usual. So before he gets into that, because I know that's where he's going, I can see him sitting there. I want to ask you too, just as you think about looking at the economic data set, what gives you confidence that things are somewhat different this time? And you brought up M2, it made me think about aggregate monetary growth being low. We've seen velocity go down. We have leading economic indicators are bad. The yield curve's inverted. The labor market's strong. But what gives you confidence that we can avert this recession in 2023? And what are you looking at that really instills that confidence today?
Yeah, so first of all, there's a bunch of flaws, I think, in some of the measures you mentioned. So the circular aspect to it. So the leading economic indicator, what's in there? The yield curve and the stock, and the stock market, which in itself is already discounting or depressed. So it's like the snake eating its own tail, right? And these things, like, the yield curve has been inverted for a while now, like that. If you go by then people do all these measures. Well, no, you need to look at the 3 months or the 15-year. No, the yield curve has been inverted for 16 months. I haven't had the recession. So, and I'm not sure that the
is that potentially like a dynamic of the market participants too? That's one thing. Yes. I wonder, is that a bunch of people that are invested in the market haven't seen an era of inflation, or haven't seen a 4 or 5 handle, right? And so it's like, oh, this is going to derail things.
Yes.
Yeah.
No, I started, my career as a quant, and one thing you need to remember, models always want to revert to the mean. You feed them historical data, and it was going to tell you it. And you see that if you look at the swap market inflation expectation at any given point, even though I was running up to 2%, the swap market saying, no, it's going to be down to 2. It's going to be down to 2. That's what models do. until they reset, right? Until like you keep being surprised enough, and then you realize, oh, actually my mean was wrong. I'm going to reset to that higher mean. So there's this kind of adaptive expectation, if you will, mechanism, which, and I mean, the same was true the other way down, you know, in the 80s. I mean, people were worried about inflation, even though it was deflating very clearly. You made a killing with long-term bonds in the early 80s, right? There was a huge term premium baked in. That was the long memory of the inflationary 70s. I mean, remember when, you know, Clinton had his budget, and I think it was Carville who said, if I could be someone, I'd be the bond market, because I could scare anybody. You know, that the bond market vigilant. Like, this is the mid-90s.
He said that great New Orleans, thick, you know, French quasi, you know, Creole
Yes.
voice. Right?
Yeah, I can't do it, but you know what I'm saying? Like, this is the mid-90s. This is the biggest economic boom. Growth is great. The budget is soon going to be in surplus. China is going to join the WTO with great moderation. And still at the time, you know, people were worrying about inflation from 15 years ago. So I think we are in the same camp here with, you know, the market pricing out a recession. And I think that's where the recession thing comes from, because you know, you feel, oh, like you want inflation to come down. What's the fastest way to get that? It would be to have a recession. And I think that's why you get all these kind of bets for a recession, which in a way are self-defeating, right? Because it ensures that rates stay low at the long end. So because rates are so low at the long end, companies can lever up. We still have negative real rate, right? For a lot of companies, like the top line is growing by 8-9%, which is nominal growth right now, and they get to borrow at 4%. So we don't have restrictive monetary policy. Like I'd be a lot more worried about a recession when actually we see a steeper yield curve.
Right. But you have 4, but the weighted average cost of capital is significantly lower. 4 is only if you're going to market today.
Yes.
Right. You think about, you know, when you look through the balance sheet, it's more levered than even you see there. So, you know, that's always the, you know, what I thought about during the transmission mechanism, you know, of the Fed is that we haven't seen anything yet. And then, you know, we kind of see this banking issue. And so tell me, lastly, why you don't feel that this banking dilemma is a problem. I know I said Sam could ask the next one, but I just can't ever resist. So, you know, feel free.
Yeah, I mean, I think it's serious. Don't, you know, I think we'll see more banks failing for sure. But listen, we have a long history of bank failures in this country. We have the FDIC, we have a resolution mechanism. The banks that are failing are not systematically important. They were, you know, SVB took money from VCs. I mean, boo-boo, I'm going to call on VC, First Republic Bank. It was like private. And anyway, everybody's going to get their money back, right? I mean, we insured the deposits anyway. And then at the end of the day, we're just going to concentrate the banking sector. You know, JP Morgan's going to take them all over. Yeah, we'll have a 3-bank banking sector, basically administered by a mix of the Fed and the largest banks. But when it comes to you know, credit creation, and I'd be a lot more worried. I mean, it's gonna slow for sure, but it was slowing anyway before. And you know, I'd be more worried in Europe, where you see banks are credit in Europe. In the US, it's about only a third, right? We have very vibrant capital markets, a lot of private lending. We have vibrant stock market as well. You can raise money there, and you have all these pools of money. Like you look at private equity, they're sitting on 2.5 trillion cash. So yeah, I live in San Francisco. I can see the empty buildings and the way downtown looks. That's not pretty at all. But I also know that you have a lot of people with a lot of cash that will eventually can take over, and will be surprised by the ease. Of course, price has to adjust that, but that's a healthy thing. Again, that is a healthy thing. Like you need to reprice assets, you know, change the purpose. We need to let the market, it's just the market doing its thing at the end of the day. We shouldn't be afraid of it.
All right. Give a pause there in case Sherman wanted to jump in again and take away the
Okay, so on that note, no, I fully agree. Let's let capitalism work, and that's what we haven't seen for a while. But again, no one likes it because you have losses, and you have to be more prudent in risk management. So anyway, Sam, take it away. Go for it.
All right. So Sherman teed it up with some free advice on asset allocation. So let's stick to that. Change gears to that theme, I should say. What do you like today? How are you positioning for your asset allocation type? Your advice on asset allocation. I guess, you know, since we have a lean towards fixed income, why own anything other than T-bills today for your fixed income portfolio too? Right. I mean, I'm seeing here high 5s, even depending on where you're at. If you want to dance around the X date,
Yeah. Oh, yeah. Do that. Pick up
Yeah.
that. Pick up this extra 20 bips or whatever. Yeah. No, that would be.
Remember that extra, those extra bips are only a tick in trading. So it looks good on the screen, but when you actually try to make the money on it, unless you're throwing billions at it, that tick doesn't matter much,
Unfortunately,
That's dirty bond stuff. Sorry.
I buy my bonds on Treasury Direct, so I get the auction, and I'm not. Unfortunately, I'm not. I can't move the Treasury market with my 401k. Yes. But yeah, no, of course I love cash. Of course I do. We have positive real rates for the first time in, I don't know, like 10 years. And I think you want to stay at the front end of the curve, right? Because if I'm right, the Fed it's just going to hold there. But to hold there for much longer than the market prices. The market price is forecast by the end of the year. That to me is the biggest mispricing. And then the way you make money, you can actively make money by selling, interest rate futures or taking a position in your dollars, something like swaps. But if you're just kind of a retail guy, yeah, you just stick at the front end, you compound at 5.5, and that's good. And because if I'm right, and the curve needs to reprice at some point for these imaginary cuts that have been in the curve for many years now, everything's going to get a hit. So that's why I'm kind of bearish on even though I'm somewhat more bullish than consensus on the economy, I'm somewhat bearish on the stock market. I think we shouldn't be at 20 times earnings. Like when you have the Fed funds rate at 5%, and even as an economic bull, I acknowledge the economy is slowing, right? And we already had 2 quarters of declining earnings. I think there's going to be 2 more. Your EPS, target EPS is probably around 200. I mean, slap a maybe 16 multiple on that. That's 3,200. I mean, I don't get to 4,000 with that. So yeah, I mean, not the most exciting call. I think you can find, if you're willing to go abroad, especially on fixed income, like go to Latin America. Brazil, you can get 13% short-term rates there. Inflation is 6% and falling. You get 7% real yield in Brazil. Mexico is about the same. So there you can actually find, and maybe you can go a bit further in the curve there, because indeed you will see cuts here. I'm not sure we'll see cuts in the US. Like if you want to pivot, maybe go to Latin America. That's on the fixed income side. On the equities,
you do local currency as well on that?
Yeah.
Or you?
Oh yeah.
Yeah, of
Oh
course.
yeah. Oh yeah, local currency. Yeah, I mean, because that's why you get. I mean, if you buy dollar bonds, you don't get the.
Right.
I mean, you get a spread over it, but you don't get the big 13, right? So, and again, because I'm somewhat bullish on global growth. I mean, a lot of problem the EM is that the leverage bets on global growth, right? So when things go well, they boom, and then it's a boom and bust, right? I think people are pricing a global bust when more likely, I mean, I look at the world, I see China is reopening. I see Europe is not falling off the cliff like people thought. I see the US, all these economic surprise indices. So that should benefit, I think, emerging markets next year. The fact that, it's kind of you've actually heard the dollar smile, right? The dollar is strong when things are really bad or when things are really good. I think we're in the middle. And when you're in the middle, you want to be, especially when you have these very high carry, that's when emerging markets tend to thrive. Equity space, obviously, because of my pro-growth bias, I like value. I like cyclical. Some of them have been completely hammered. But I think you'll have time to buy stocks 15-20% cheaper in 3 months. That is my guess.
Okay. What about the other part that does have some of that pro-cyclicality, and it's the commodity market? What StoneX known for commodities too. What do you like there? What don't you like?
Yeah, it's been difficult for me. I must say I've been wrong on that. I thought commodities would perform a lot better than they have. I thought oil would, you had this kind of perfect storm. I think it boils down to China reopening not being as sharp as people thought. My inclination is that it's just a matter of time. Maybe people.
Do you think that's a delay? That it's
Yeah.
just the same.
Yeah, it's happening, but more slowly. Like people just thought, boom, it will. And then the thing is about commodities, we remember commodities need to be consumed, right? I mean, oil is a toxic substance. You don't store oil in the garden, right? Or you don't, you don't get iron ore delivered to your front lawn. So commodities do not discount the future, right?
He tried to do oil arbitrage last year with the negative, or 2 years ago, the negative price. 3 years ago, I guess now. Sorry, but he did do that, and so he didn't even think about the effects of the toxicity.
The
Yeah,
EPA
so-
wasn't on my mind.
So the point is, like, I think as a global macro guy, I tend to have this, forecasting bias. Like, but I'm always looking in the next 6-12 months. Commodities, what matters for commodities, what's happening now, and what's happening now is you got Russian oil leaking out of Russia, being sold, in various ways by, India, Turkey, whatever, Iranian outputs coming back on, and that Chinese demand is not coming back online as fast as people think. So oil prices have been, in that kind of boring range for a long time. I still think over time, and not just for oil, but for a lot of commodities, you look at things like copper, you look at things like lithium, you look at the forecasted demand because of the demands for electrification and renewable versus the available supply. It's almost mathematically certain that we're going to see another commodity super cycle. Whether it starts now or in 6 months, I don't know. But I think over the long term, and also if I'm right on the inflation call, commodities will have a role to play in your portfolio as diversification. If I'm right, the biggest risk to portfolio is going to be inflation. And you don't hedge inflation with bonds, you hedge inflation with commodities. So that's why I think you get that, traditional asset allocation portfolio, it's whatever, like 60-40, right? Maybe it's going to be like 60 2020 or something, the new less fixed income and more commodities.
All right, I'll take a 60-30-10, but I'm with you. I think so, just because on a vol, it really does.
Yes.
You don't need a lot of times. It can really help drive. Let me just ask one last question before we get to Sam's favorite part of the show. And one thing you talk about a lot is risk management. What is one risk that you think people are taking too much of today? And the obvious answer tends to be the stock market in the US, but what do you think is one of those risks out there that people either have too much exposure to or are completely ignoring today?
Duration. I think every portfolio is too duration heavy. Even bond indices, right? I mean, if you look at the duration of the Barclays lag, and it's just people responding to incentive, right? I mean, because we had these flat or inverted yield curves, companies have been, I mean, I would have done the same, right? I mean, if I can borrow for 10 years cheaper than 5, of course I will. So the duration has extended, and people have way too much duration in portfolio. Even the stock market itself has a lot more duration than unusual because of the weight of the magnificence, the 5 companies that are like 35% of the index, right? Highly valued growth stocks. So I think duration is, and I mean, if you believe like me that we're gonna have this kind of secular inflation, possibly some rising rates, geopolitical issues, you don't want to be in a portfolio whose value is dependent on things that may happen in 20 years. Like you want tangible.
All right. I think that's great, Vincent. Well, look, it's been a pleasure having you on today. One thing is too, how can our listeners, get in touch with more of your thoughts, your research, your firm? What's the best way for them to do that?
Well, the easiest way is to trade with us, StoneX. Some of them may already do. If you big on futures, commodities. If you do, call your StoneX rep and see if you can get on my list. The next easiest thing is Twitter. I mean, Twitter is amazing. I met some really smart people there. People are helpful. I try to be helpful as well. So my handle is at Vincent, VINCENT, Deluard. DELUARD. And then if you go under my pin tweet, there's a link where people can sign up for my research. You can get, I think it's 2 months by default, but DM me if you want. I've heard you talk about that. You have a report. Like I said, I've benefited from a lot of people helping me out. So I try to share back.
That's awesome. That's great. So, well, thank you for spending time with us today, Vincent. But as I promised, before we let you go, I have to introduce you to Sam's favorite part of the show. So, Sam?
All right, Vincent, and that favorite part of the show, it is called Sherman Says. I'm going to offer a series of alternating unique prompts between you and Sherman to elicit a top-of-mind response. I'm going to kick it off with Sherman first so he can give you an example with money printer.
Brr, right? I mean, that was the best memes of the last 5 years, right? But seems to be shut off a little bit these days. But don't worry, as Vincent said, you can turn it on when you need to.
That's right.
You don't have to default. You just go brr, and you finish the job.
Keep the power on. Keep that printer going. So, all right, over to you, Vincent, with passive bubble.
Yes. I mean, yes. I mean, Mike Green, see, he's a good friend of mine. He's done some terrific work on the impact of passive. I recently wrote about target date funds and how their rebalancing pattern kind of match with what the stock market does. I think it's happening for sure. It's putting upward pressure on valuations. It's having all sorts of impact, and we don't talk about it. If anything, we institutionalize it, right? I mean, we basically have given, a handful of one company a monopoly on the retirement savings of all Americans with this kind of target date fund complex that gets invested into index funds. So look into it.
Mike is a Sherman Show alumnus like yourself now, and so we got a lot of respect for his work out there. I think he does great stuff out there, and he's not like the broken clock. He'll be right eventually. It's just that if you've seen these structures before, it happens, right?
All right, back to you, Sherman, with rate hike. Pause.
Yes.
All right. Wage growth.
It's for me.
Yes, sir.
Stronger than you think.
Okay. And FOMO.
We're stronger than you think, I like to use other people's answers for the next one, but I want to say it's one of the more powerful forces in markets. Because not only does it get the speculation going, but then also once you get this thing like the momentum, the passive indexing, right? And all of a sudden, then people have FOMO because they hear about others doing it, and it just feeds on itself. So I think it's one of the more powerful forces out there.
Indeed. All right, back to you, Vincent, with leverage.
Use carefully.
Back to you, Sherman.
It's one of the most powerful forces out there.
Most dangerous, potentially.
Yeah.
All right, Sherman, down payment for residential mortgages.
Do it. I guess we don't have the piggyback loans as much. I think they exist somewhere, out there. But from what things we hear from our team and everything, it seems like 75 to 80 LTVs are the norm across the spectrum. So do it, have some skin in the game, and if you put down the 80 LTV, you only get 5 times leverage, right? If you put down the 20%, you only get 5x leverage. You don't need 10, right? So anyway, that's all I gotta say.
You don't need 10, but how about this? So today, the reason that prompted that, Sherman says, I saw today in the headlines, a mortgage company, Rocket Mortgage, started offering 1% down mortgages. So it just reminded me a little bit back to the mid 2000s, early 2000s.
Yeah, you can't even cover the closing cost, on the transaction cost, right? Remember the friction that exists there too.
Yeah.
So,
and that's without mortgage insurance as well. But Rocket Mortgages apparently, again, read the news, but it's they're going to cover 2% of it upfront too, the Rocket Mortgages. So it's pretty interesting to see that it's going back to those kinds of scenarios.
Sounds like someone's hurting for origination is what it sounds like to me.
Hey,
So,
I refire these guys. So I'm whatever dumb stuff they're doing, I'm very happy to be a debtor to them, Let the creditors deal with it. If they want to buy market share with aggressive pricing, let me be on the receiving end of it.
That's right.
I love it. Love it.
All right, back to you, Vincent, with let's see here. Hopefully this one rings a bell, but preference for the present. Preference for the present.
We're mortal, so I have a preference for the present because I will die one day.
Okay. All right, Sherman, $1 trillion coin. Actually, you know what? Let me change that. Let's call it $30 trillion coin, platinum edition.
I'd like to have one of those because I'm going to die one day, so I'd like to have one sooner than later. Why not, right? If the Bernanke wanted to have the trillion to make it work, they did QE without it. It's all just accounting stuff. If you believe that coin's worth 30 trillion, I'll sell it to you for 30 trillion.
Well, don't try to sell me that Zimbabwe note that you got in your wallet there.
It's 100 trillion,
100
and
trillion,
it's still on offer if you like it.
All right. To close us out here, Vincent, U.S. consumer.
Stronger than you think.
And it has been all throughout the last 6 quarters, right? Where people thought we had a collapse last year. So, Vincent, thank you so much for spending time with us. I know I enjoyed it. I hope our listeners did as well. For those of you that are listening to this through your favorite podcast source, you can always see the videos of us. Sam and I put up some new graphics here on the screen to try to cover up the world behind us. But also you can see us on the YouTube channel, youtube.com/DoubleLine Capital, where you can find this and our other videos. You can see all the other stuff that we put out there as well. So Vincent, thanks again for joining us. Again, for those that you don't recall, it's Vincent Deluard, global macro strategist for StoneX. So thanks again.
It's a fun. Thank you so much.
All right.